Hi, and welcome to this week's market presentation. Latest news. Starting in the latest news, the war in Iran continues to create extreme market volatility as the situation evolves between optimism regarding an end to the conflict and pessimism regarding the progress of peace talks and the reopening of the Strait of Hormuz. Over the past week, we saw Iran briefly declare the Strait of Hormuz open, while the US maintained its naval blockade on Iranian ports, intercepting multiple vessels. Over the course of the past week, Iran then reimposed strict controls on the strait, with reports of several attacks on ships trying to cross the strait. Overall, transit through the strait remains effectively closed, halting most commercial traffic. At the same time, peace talks between the US and Iran in Pakistan collapsed following limited progress on resolving the nuclear issue and what it would take to force Iran to reopen the Strait of Hormuz. Nonetheless, the US extended the ceasefire indefinitely in one of the few bright spots over the past week. The impact on energy markets was significant price swings over the past week. Brent crude oil prices plunged on Friday through optimism regarding an end to the conflict before surging above $105 a barrel as markets opened over the weekend following the collapse of talks and the continued halt of transit through the strait. Natural gas prices followed the volatility seen in crude oil markets, falling sharply before rebounding quite strongly. Over in Europe, the European Commission continues to consult member states on a proposal for a temporary crisis framework. The European Commission is set to unveil its Accelerate EU Crisis plan over the coming weeks. At the same time, the European Commission is considering a further reduction of gas storage filling targets to 75%, following the 10% reduction we saw apply to last year's storage season. Additionally, the EU is taking further action to phase out Russian fossil fuel imports. Lastly, discussions continue to be ongoing in the UK and the EU to decouple electricity and gas prices in what could be a fundamental change to market dynamics. Overall, policy measures aim to mitigate price shocks, particularly during such temporary crises such as the ongoing war in Iran, while also adding to the regulatory uncertainty as markets remain more uncertain regarding what future policies will bring. Lastly, regarding the impact of the reduction of storage levels to 75%, while they could ease summer injection demand and reduce some of the pressure on market prices over the coming months, it will certainly signal additional winter supply risk, especially if we see storage levels be filled up to lower levels ahead of the next upcoming winter. Weather. Regarding weather conditions, temperatures across most of Europe over the next 7 to 10 days will remain mostly seeing above average temperatures across Europe in a continuation of the mild weather that has helped reduce total gas and power consumption across Europe, alleviating the upward pressure that we are seeing in the market due to the ongoing supply disruptions through the Middle East. Precipitation continuing to be limited throughout most of the coming week before picking up early next week with widespread precipitation across most of Europe. Nonetheless, the Nordic region is still seeing relatively dry weather forecast over the next 7 to 10 days. Wind speeds, which have picked up over the last few days, are expected to continue at least through the beginning of this week before easing down once again through the middle and beginning of the following week. Crude oil and LPG. Crude oil markets seeing very high levels of volatility over the past week ended up seeing significant gains through prices through the 24th of April, with both Brent and West Texas crude increasing on average of 15% on the week, very much as transit through the Strait of Hormuz remains limited, and optimism regarding the end of the war was decreased following the collapse of peace talks between the US and Iran. Overall, the outlook still maintains optimism that the war will end sooner rather than later, given the sharp backwardation in the price level, especially as we look through prices in the second half of 2026 and for 2027. Natural gas. Natural gas prices saw a rebound, as mentioned earlier, with prices increasing roughly 16% for the remainder of 2026 and up nearly 13% for the front year, as the supply disruptions and the disruption to the physical flow of gas and imports into Europe continue to take its toll on Europe's total supply of natural gas. Storage levels across Europe continue to increase over the past week, now around 32% full, but nonetheless still lagging behind both last year's levels and the average since 2012. More concerning is the fact that storage levels at key countries, namely Germany, the Netherlands, and France, remain below the European average, with Germany and the Netherlands noticeably below the European average. Looking at total supply and demand, total supply of natural gas saw another sharp decrease over the past week, pushing total supply to the lowest levels in over 5 years, as the impact of the war in Iran continued to reduce LNG imports, and as we are in the midst of the Norwegian infrastructure gas maintenance season, which saw a further decrease in Norwegian gas flows to Europe. Fortunately, total demand also saw decreases over the past week, similarly below the levels we've seen over the past 5 years, alleviating some of the pressure on the market, at least in the very immediate term. Storage injections, as a result, were able to remain near the average since 2012, although slightly below the levels we saw in 2025. Looking at the European gas supply mix, we see that sharp decrease in Norwegian gas flows versus a couple of weeks ago, and the continued decrease in LNG sendouts as LNG imports into Europe continue to decrease week over week, pushing LNG sendouts now just below the past 5-year average, noticeably below the levels we've seen over the last couple of years. In terms of global LNG export destinations, we see that continued decrease in the share of imports going to Europe as Asian markets continue to outbid European consumers to secure spot LNG cargoes. That is highlighted here with the price competition between Asian and European markets, with Asian markets remaining at a premium to those of Europe, largely due to the fact that Asian markets have been more directly impacted by the halt of physical flows through the Strait of Hormuz. Investment fund positions remain heavily in long territory, and although we have not seen a further increase in long positions, the net long position of market participants very much highlighting the bullish sentiment in the market. Coal. Coal prices saw a rebound in the market, similar to what we've seen with natural gas prices, with prices up across the board. Increases were most noticeably felt in the Newcastle index, up 8% over the past week, as Asian demand for coal increases further as natural gas prices increase, pushing additional gas to coal switching. For Europe, we see similar trends with increasing levels of gas to coal switching as a result of the higher natural gas prices in Europe. Additionally, in Europe, ARA coal stocks remain at multi-year lows, and given the increase in potential demand due to the high gas to coal switching, we are seeing additional pressure on the European coal market. Fortunately, global supplies of coal right now remain sufficient to meet the growing demand, although as we move deeper into the year, and if we see additional increases in coal demand in Asia and in Europe, that balance is expected to tighten further, adding more upward pressure to the markets. EU and UK emission allowances. Carbon allowances, on the other hand, saw a decrease in the price level over the past week, with European December 26 product prices down 3.3% and UK December 26 products down 2.4%. Emissions across Europe from the power sector remain at multi-year lows on the back of that easing total demand for electricity as a result of favorable weather conditions, but also the strong performance of renewables, especially over the past week, reducing usage of gas and coal-fired power generation. Nonetheless, we've seen an increase in the level of net long positions, primarily as a result of a decrease in short positions in the market, as market participants continue to weigh the reports of policy changes at the European level to try and target the high carbon price we are seeing currently, which could reduce prices, but at the same time, given the commitment of the European Commission to pursuing its carbon emission targets, we are not seeing additional bearish sentiment in the market, with markets more firmly on the bullish side for the time being. Electricity. For electricity markets, the increase in natural gas prices was more than enough to push electricity prices further upwards, even as carbon prices came down over the past week. The increase over the past week has been more modest for electricity, with prices increasing by just around 5 to 5.5 percentage points for the rest of 2026, the front year up nearly 5.6%. Prices saw a similar price evolution as that of Germany across most European markets, a couple exceptions being the Iberian Peninsula and Polish power prices. But nonetheless, we've seen a general upward trend in the price level for electricity over the past week. In the Nordics, on top of the upward movement due to gas prices, the poor hydropower outlook for the rest of 2026 also weighing on the region's electricity prices. Looking at total demand and residual load for electricity, we see a relatively stable total grid demand, slightly down week over week due to those favorable weather conditions, and the strong renewable power performance helping reduce the residual load to the lowest levels in over 5 years for this time of year. Looking at the European supply mix, we see the further decrease in total nuclear power output, evidenced by the decrease in French nuclear power output, but nonetheless, it does remain near the highest levels we've seen over the last 3 years and near the top of the range over the past 5 years, in what has been a welcome sign that has primarily helped to limit the upward movement in French power prices and in neighboring countries as well. Looking at the renewable and fossil generation, we see that nice uptick in renewable power generation once again at record highs for this time of year, which in turn have helped reduce fossil fuel power generation to the lowest levels in over 5 years. Taking a closer look at the renewable power generation, we see the increase over the past week largely driven by a sharp rebound in wind power generation and also a further increase in solar power generation, which continues to produce at a record pace so far in 2026. Hydropower generation, on the other hand, continues to perform poorly so far this year, with reservoir generation down to the lowest levels in over the 5 years, largely driven by the drier weather we've been seeing and the lower overall hydro storage levels across Europe. For fossil fuels, we see the decrease was across the board, with decreases for both gas and coal, although the decrease in fossil gas generation was more pronounced, not just due to the impact of the stronger renewable power generation, but also the aforementioned gas to coal switching. Looking at hydro reservoir levels, we continue to see the ongoing deficits in the Nordic region, particularly looking at Norway and Sweden, and the other deficits seen in France and Italy. Overall, as the weather forecasts indicate additional rain, especially at the beginning of next week, we'll certainly see a boost at least to levels in Italy, Switzerland, and France, while the weather outlook remains relatively dry for the Nordic region. Lastly, looking at guarantees of origin, we see a further upward movement in the market, with prices increasing another 15 to 20% on the week in what has now been a more continued upward trend over the last 2 to 3 weeks. Overall, the supply of guarantees of origin through the rest of 2026 has deteriorated, driven by the poor hydropower output, especially from the Nordics. At the same time, demand for guarantees of origin continues to see a more bullish sentiment, with expected increases in demand for guarantees of origin, especially as we see additional data center and AI-related loads come online. Overall, when we look at the cumulative renewable generation in AIB countries, we are now continuing to see a trend of slightly lower total renewable generation versus the record high we saw in 2024, largely driven by the poor performance of hydro and the slightly worse performance of wind versus that record year. The one bright spot continues to be solar power generation, which continues to perform at a record level. That covers this week's market presentation. Thank you for joining.